Okay, so all right, so our previous topic, which we have just finished, but we'll quickly recap here. Okay, players in financial markets, different types of players. We've classified 3 types of players: arbitrageurs, hedgers, speculators. High-level classification is 3 categories. Then we have 2 subcategories within speculators. We have directional speculators, and we have market makers. So the implication of this kind of a sub-classification within speculators is obviously that the market makers are not directional speculators. Okay, have you understood what the reason for that is? We'll quickly run through that once again. Okay, we can take a different example here with a different type of chart. Okay, so now here, for instance, in the euro, let's say this is a chart of all our euro charts. Actually, these are different time frames. Okay, so the market that's being covered is the euro USD spot market. The same thing that's here. You can see the price 112.38, which is the same as the price you see here, which is again 112.37.8 here. Let's try and see if we can configure something here. Okay, so you can see the euro prices here as well, the same price. Okay, so these are spot euro prices, spot foreign exchange prices. And so if I had a view, let's say, why is this directional speculation? Just quickly recapping. So if I had a view, let's say that at this point of time, if I have a view that the euro is actually going to go up, okay, and I buy the euro. Okay, and so therefore what I need in order to make a profit, what I need this to move up, right? Obviously, so I need a big directional move in order to make a profit. So those who do this stuff, so you've already seen this. Now I'm giving a special name to it. You're already familiar with this. All these people who are asset managers, that's exactly what they're doing. They are buying particular stocks because they think those stocks are going to go up. If they feel that certain stocks are going to go down, they might go short. Okay, or in India, of course, the ability to go short is quite limited because the market is not well developed for shorting. But in theory, you could go short if you had a bearish view on a stock. Okay, so the implication, the reason I call these people, so the typical example of a directional speculator is a asset manager. Okay, typical asset managers, traditional asset managers that you're aware of, mutual fund managers. These are all directional speculators. Anybody trading for their personal account typically is also a directional speculator. Okay, because they need a big directional move to make money. Alright, so we are distinguishing that from market makers. I think the font is pretty big now for everyone to see, right? So if we want to make sure that we see the ask price also properly, I don't need this actually here. Alright, what happened? Something happened there. I must have knocked it out somehow. Okay, it's gone to the top. All right. So you can see the foreign exchange prices, which are live right now. Okay. You could also see NSE prices if you wanted to. We can also put in NSE prices if we put in TCS. Here you get data consultancy services, NSE. So you have to choose the right. Remember that this is actually a US listed stock. So this has got the same kind of same ticker. So you have to be careful. So you have to choose this one. This is coming back to the question that Mittal was asking the other day. How do I know that this is the listed a US stock, or why is this listed on the NYSE? When you see it, it asks you which particular stock do you want. Okay, so you can see the market makers who are making prices. Okay, we can either look at this or we can look at a different example. Let's say on the euro, very tight spreads on the euro. You can see almost no spread. So I want to see something where there's a fairly wide spread. Okay, so let's look at some of these US equities, because I want to give you a good example Here also the spread is not that good. So let me give you a better example by looking at stocks where the spread is quite wide. Amazon would be a good example because it's not trading right now, so the spread is quite wide. So you can see, everyone can see the spreads on Amazon. 17, we'll just say 71.94. We just call it 72 and 76. Is that okay? We'll round it up and say 71 and 72 and 76. All right. So now, if you want to sell, these are the market makers' prices. Okay. So if you want to, okay, before we get on to bids and offers, that's actually the next subtopic. So the point about the distinction between the directional speculators and market makers. Okay. Why is that distinction being made? The implication is that market makers are not directional speculators. Why? Because the market makers actually do not want a big directional move in the stock, in the asset price. Okay, because ideally the ideal situation for a market maker is, okay, so to some extent we have to understand bids and offers. Okay, so go back, and if we still focus on the Amazon price, to make it easier for you, I'll try to insert one here and one here so that we can make it stand out. Okay, so we look at the Amazon price, and so we have 72 and 76. All right, and so this is the market maker quoting 72 and 76. So if you have to sell, if you want to sell Amazon, at what price will you sell? 72. Yeah, we are calling, okay, it is 71 now, rounded is 71 now, so let's call it 71. So we will sell at 71. Is everyone clear about that?
Yes, sir.
These are all basics, so please make sure, if your basics are not clear, you will have problems later on. Okay, so make sure that your basics are clear. Simran, I think you're not clear about this. You have to pipe up on your own, right? I have to like scan the class and see the expressions and find out from your expression that it doesn't look convincing.
But I had a confusion about bid and ask price.
So you have to ask me then, no? Why now I have to poke you and then only you'll pipe up? You should pipe up on your own. Yes.
So
what is the problem?
Difference between ask and bid.
Okay, which is the bid and which is the ask? Do we know? The Amazon now, what is the bid? We'll just talk about the last two digits. 73 is the bid.
Yes.
Is everyone clear about this? This is the price at which the market maker is willing to buy is called the bid. Okay, so the bid and offer is really from the market maker. So the easy way to remember this is to say that this is, I mean, you have to think of it from the market maker's perspective. So this is all basic stuff, but you have to get your lingo and jargon correct. The concept should be clear. Once you master this, then you can just move on and you don't have to visit this again. Okay, so the bid, the price at which the market maker is willing to buy is called the bid, and the price at which he is willing to sell is called the offer. We have this here as well. We have already gone through it. Trading on quotes. Okay, so market makers we refer to as MMs. Okay, so this is what we see. The price at which MMs are willing to buy the base asset is the bid, and the price at which they are willing to sell is called the offer. So it's from the market maker's perspective. Okay, clear? And so obviously the market maker is the price maker, and if you're the price taker, any customer who's dealing with the market maker is the price taker. Okay, or the customer or the price taker. So he has to deal on the market maker's terms. Okay, so therefore he will always get the worst of the two prices. Okay, so if he wants to sell, he'll have to sell at the lower price. If he wants to buy, he'll have to buy at the higher price. In other words, to be more specific, so the customer, the price taker, if the price taker wants to sell, he will have to sell at the market maker's bid or offer. When the price taker wants to sell, because he has to deal on the market maker's terms. So remember this you have to be clear about. This is where you have to clear up your, it's not very complicated at all, but you have to spend some time thinking about it. This is where your revision comes in. If you are encountering these concepts for the first time, they're not very complicated concepts, but at the same time it's a new concept that you're encountering. If you're not revising it, if you're not going to revise at home, then you will not be able to master the concept. If you do a little bit of revision, once you master it, that's it, then you don't have to worry about it for the rest of your life. But you have to spend that little bit of time revising with your own notes. As I said, go through the video, each go into segments, pause it, watch what's written on the screen, what is being said, then write your own notes. And once you do that, then you're completely you basically don't have to study for the end terms after that. Because all I'm going to ask you is all the stuff from here, and then maybe there'll be some googlies which test your concepts and all that. But most of the questions, even if you can't get the googly, you can still at least get 85 to 90% of the paper correct, which is good enough, okay? And that's all you will be tested on. So essentially that's you just have to make sure that your concepts are clear, where all the concepts are being taught, everything is clear, and you master it once, and that's ends your preparation for the exam as well. And it gives you a good foundation of basic knowledge about how markets operate, all right? So it helps you to understand all kinds of markets. So bids and offers, is it very clear now? Market makers, so all these concepts should be clear. Market makers, also called price makers, okay, MMs, price makers. Customers, who are price takers, okay, we can write it here, okay. Yeah, so the customer who deals on the MM's prices is called a price taker. Price maker, price taker. Market maker, customer. So the customer must buy at the MM's offer, and the customer must sell at the MM's bid. Clear? You have to deal on his terms. So this is where the other part comes in, that a market, see here the implicit idea of the definition of a market has already come into the picture, which is a market is a venue for the exchange of assets, right? So if the customer is selling, and here we're talking about with reference basically, the implicit reference is to the base asset. So if the customer is selling the base asset, okay, so the prices are all for the base asset, 1 unit of the base asset. So if the customer is selling the base asset, then what is the customer buying? He's buying the terms asset, okay? And if the customer is selling the base asset, then the other side of this picture is the customer is selling the base asset. So what is the market maker doing with the base asset? He is buying it, right? So this is how you have to work your logic, that each party is doing the opposite. So each party is doing the opposite with respect to the base asset and the terms asset, and each party is doing with respect to, once you freeze either base asset or terms asset, whatever one party is doing to that base asset or terms asset, the other party is doing the opposite. So if one party is selling the base asset, that means the other guy has to be buying the terms base asset, all right? So this is also, as I said, it's not complicated, but it's a little, it's a new concept. So you just have to spend some time understanding it from all these different angles. And once you do that, then you are very clear about the concepts, right? What is happening in a particular transaction, right? So you see here we have not violated our definition of a transaction in a financial market being a contract to exchange assets. So that's all that is happening. Customer is selling the base asset, therefore market maker must be buying the base asset. And market maker will buy the base asset at which price? Bid or offer?
At the bid price.
At the bid price, right? So that's the definition of the bid price, is the price at which the market maker buys the base asset, right? Is this clear? Okay, all right. So this is what we have. So everyone is clear now that if you want to sell Amazon, you will sell at 73 or 77?
77.
Who said 77? Who said 77? Catch him. So I heard a male voice saying 77. Who was that? Yash? Who said? Somebody said 77. I heard a 77 from there. Anyway, doesn't matter, but you should be clear that if you're selling, you should be selling at 73. Is that clear? If you're selling at the bid price, at the market maker's bid, okay? And we don't say market maker's bid. We just say bid and offer. It is understood that this is the market maker's bid and the market maker's offer, okay? We look at prices in markets and we say bids and offers. Is that clear to everyone? When you're a customer or price taker, you're buying at the offer, selling at the bid. Yeah, don't memorize it. Make sure you understand it logically, because everything is logically connected. One party is giving one asset, taking the other asset. Okay, we have two questions. Tanya first.
So the price in the chart that is the ask price.
1 minute. No, we'll come to that. That's not the ask price. That's actually just as you can define it either way. Okay, you can instruct this charting software what price you want plotted. But in general, if nothing is mentioned, what we are plotting is actually the mid price. Okay, so in general, what is plotted here, the mid price would be 73, 77. So the mid price would be 75. So in general, charting software will plot the mid price by default. But you can always instruct the charting software that I want you to plot the mid price, the bid price or the offer price. Okay, so the chart that normally is the default value plotted is the mid price. Okay, this mid price is sometimes also called mid market. So if you hear the expression mid market, means it's the average of the bid and offer. Okay, all right. So this much everybody is clear now about. Okay, that this concept of two-way prices. Market makers. What do the market makers do? We are trying to understand still. We actually went ahead a little bit. It's necessary to do this journey forward to understand bids and offers and how it works. To understand the market making business. We're trying to understand the market making business, and we're trying to see why we are saying that market makers are not directional speculators. They're also speculators. Okay, so but everyone's clear about this operation now, how the market works. The market makers sit there making prices, two-way prices. Two-way prices means there's a bid and an offer, both. Okay, and then the customers come and deal on their prices. Okay, so now what is the ideal situation from a market maker's point of view? Okay, if you look at the situation from a market maker's point of view, he doesn't really want this kind of movement that you see here. Say for instance here you see this dramatic fall in the price. He doesn't really want this kind of thing, because it could easily happen that, remember that it's not going to be, every situation in real life is not going to be ideal. It's not that in at every point of time or every hour, if you look at the market maker's book, okay, or his business, you'll see that 50% of the customers have sold to him and 50% have bought from him. Life doesn't work like that. It's not that regular. Okay, every day there'll be some kind of imbalance or some sort. Okay, so there may be people who are, like for instance on the NYSE, there are designated market makers for each stock. Okay, for groups of stocks you have designated market makers. They are called specialists. Okay, now these guys, what they have done, I'm taking the example of the NYSE specialist because that's a good example of a designated market maker. So these guys have a responsibility. So General Electric, anybody wants to, all the General Electric orders that come, sell orders, buy orders for General Electric common stock, there's a designated market maker who has to take care of that, and he's probably taking care of a whole bunch of other stocks as well. So now he has to quote, now he has a book obviously. Suppose early in the morning he is running a square book means zero position. Okay, then suddenly somebody comes and gives him the other expression that we use is that we say gives. When somebody hits the bid, we say gives. And so we say at this point, I'm going to note this down here. A little bit more of jargon here, which is I'm not writing proper English, I'm going to write, it should be on the bid, but hit on bid, I'm going to again structure it like this. Here MM is market maker. So this again is market lingo, okay? So we're just making sure that you're aware of all these terms. Okay, so what are we trying to say here? We can see the bids and offers in any market. When we look at any market, we can see the bids and offers. You can see everything lined up here. You can see how tight the bids and offers are on the dollar yen. The liquid currency markets like the euro and the dollar, you see how tight it is? You have to go to the fifth decimal to see the difference. Okay, that's what is meant by that's what happens in a liquid market. The spreads are very tight. We're coming to that a little bit later. But so we have understood all this. We can see the prices. So when the customer trades when the customer sells to the market maker, okay, we say that the market maker. So that means he's hitting the bid. Okay, so we say hitting the bid or hitting the offer, hitting the bid or lifting the offer. Okay, so when the market makers hit on the bid, we say the market maker was given. So if a market maker is saying that I was given $10 million, that means somebody traded $10 million on my bid, which means I bought $10 million worth of the base asset. Is this clear? This is just market lingo. Given and taken, I think logically you remember it, because if you are given something means now you have some units of that. Okay, so somebody gives me some chalk, that means I have some chalk with me. So somebody takes the chalk from me means I have less chalk on me, right? So given taken makes sense, because if I'm selling something, when the market makers hit on the bid, we say that he's given, okay, which makes sense, because if he's being hit on the bid, that means he's buying the base asset, right? So if he's buying the base asset, that means the number of units of the base asset in his possession has increased, because he just bought some, okay? Yes, Puneet, you're following? Okay, so that's why we say he was given. And if he's hit on the offer, okay, then we say he was taken, and which is the same, has the same connotation, right? Somebody takes my chalk, that means now I have little less chalk with me. Is that clear? So taken means he has lost some of the base asset. So we say that the market maker was taken. Okay, so the market maker might say, I was taken for $6 million or whatever. That means somebody bought $6 million worth of the base asset from him. Is this clear? Given, taken, this is other jargon that you have to be clear. So essentially how the real situation works, I mean how it works in real life is that you're not going to have a perfectly matched book. So you have let's say you look at a specialist on General Electric stock on the NYSE. He will every morning when he starts with a clean slate, with a square position, okay, suddenly somebody comes and sells him 6 million shares of General Electric. Okay, so now he is long 6 million shares. Okay, so then what might happen is he might find that throughout the day there's some kind of a selling pressure in the market. So there are not many people buying from him, but people are continuously dumping stock on him. They are continuously dumping General Electric stock on him. So by the afternoon, he might find that he's long maybe 75 million shares or something like that. Okay. So therefore, or maybe there is some in and out, some kind of, some people are buying, some people are taking him on the offer. Okay. Some people are taking from him, but net there is an imbalance. Okay. So he has an imbalance. So he's basically net long 75 million shares, let's say. At the end of the day, he might, or towards the close of the day, he might find that he's net long this much shares. So there is likely to be, in real life, there's always likely to be an imbalance. You're not going to have a perfectly matched situation where whoever sells you, I mean, if some people are selling $50 million worth of shares to you, that means they will also be buying $50 million. That's not how a market works. Okay, in every market in real life, there's going to be some kind of imbalance. You don't know which way it will be, and you don't know what the sequence of trades will be. You can't predict that, but you have to be prepared for the fact that there's not going to be a perfectly matched, book, right? So therefore, these guys, if suppose the guy has a very large net long position, okay, and after that, what happens is, let's say this. If you assume this is a General Electric stock, and after this, if you are situation like this here, and then the market suddenly drops, then you suffer a big loss, right? So these guys, so essentially market makers, because they always have some kind of imbalance in their books, maybe a huge imbalance or a small imbalance. Okay, generally according to your limits, you will try to, if the moment the imbalance starts getting a little bit too big, you will go and do a trade yourself in the market, or you will adjust your prices in some way so that you quickly reduce your the imbalance in your position. Okay, so you might have a limit, you might have a rule for yourself that if my total position goes to more than say 25 million each way, either 25 million net long or 25 million net short, I will immediately cut it back down to say 15 million. So I'll immediately go and trade for 10 million. Are you following? So the market maker might have a rule that, okay, now he sees that his net position has become net long 25 million shares. Okay, so he has this rule that now you can set the limit at any point of time. It depends on how much risk appetite you have. Okay, but obviously, can you see clearly that this is a speculative business? This is not a hedging business, because in the morning the General Electric market maker starts with a square book. Okay, ideally a market maker should behave like a day trader. He should have no positions at the end of the day. Okay, if you have positions at the end of the day, sometimes they do carry positions, but that's not good practice. It means basically that you have some position on which you're losing money and you don't want to take a loss, so you are trying to keep it overnight and try your luck. Okay, so that's not good practice. A good market maker should basically go home square. Okay, do your daily business and go home square. Okay, that's what you should do. So ideally, so once he has that, so depending on the amount of, so you can clearly see that this is a risky business. Can you see that? Because the General Electric market maker comes in the morning, he has a square position, then suddenly people come and start dumping stock on him, so suddenly his long position keeps on, net long position keeps on increasing, +6, +11, +17, then maybe after that somebody comes and buys 5 from him, so it goes from +17 to +12. Are you following? Yes. So his position, net long position is +17, then the next trade is somebody buys 5 million from him. Okay, somebody takes him for 5 million, so net position goes down to +12. Okay, in this way it will keep on fluctuating up and down. But eventually he may find at some point of time, if there is excess selling pressure in the market, he may find that he is getting net long, because everybody is dumping stock. So who are they going to dump on? They're going to dump on the market maker. Okay, so he might find that his position has become net long 25. And if he has an internal rule that 25 is his cutoff, okay, if you had more risk appetite, your cutoff could be much bigger, like 50 million, 75 million. So in this case, let's assume that this guy's cutoff is 25 million. So the moment he goes 25 million net long, okay, what he will do, I'm just giving a simplistic example, what he should do is, he should immediately go and deal with another market maker. I'm giving a simple example. He should immediately go and deal with another market maker and buy back 25. Let's say the rule is that if it goes to 25 million, I will immediately reduce it to 15 million. I will reduce the net long to 15 million. The moment the net long goes to hits 25 million, I will reduce my net long to 15 million. Are you following the rule? Sugar is not clear.
How will he reduce the net long?
Now we are coming to that, but the rule is clear. It's like I'm a bank, I'm telling you, if your cash balance drops below 50,000 rupees, you have to immediately top it up to 500,000 rupees. Same kind of rule, the other way around. I'm saying if your net position goes to 25, if it goes to 25 million, if your net position goes to 25 million, you have to immediately bring it down to 15 million. Okay, now how we'll do this, we can see easily. So if he has to bring from plus 25 down to plus 15, what transaction does he have to do?
He has to sell.
He has to sell. He has to sell 50, he has to sell 10. Okay, so from plus 25, if he can sell 10, he will come back to plus 15, which is what his risk management rule requires. So it's clear. This is an example of a risk management rule where you try to manage your position size and make sure that it doesn't get too big. Here, too big is defined as 25 million for this particular guy. Now, some other guy who has lots of risk capital can have a much bigger definition of too big. His definition of too big could be 75 million. Okay, so this varies from entity to entity. So now he has to sell 10. So he's going to deal with, let's take a simplistic assumption where he is going to deal. So if he has to deal, now he has to deal with other market makers. He has to deal with other market makers and get rid of the position. Okay, because customers, remember, customers who are price takers, therefore they are customers are price takers, therefore by definition they are not price makers. Is this clear? So you cannot go to a customer and ask him for a two-way price. Customers only do one, they come and either hit the bid or the offer and they deal on the market maker's prices. So if he wants a two-way price, he has to go to another market maker. This is clear. Okay, so therefore he has to now go and sell. It's also clear that he has to sell 10 million. So if he has to sell 10 million by dealing with another market maker, at what price will he deal?
75.
Anybody else with a different view? The question is, we have already defined this GE market maker who's got 25 million worth of stock now net long, and his risk management rule requires that if he hits a net 25%, 25 million position, either net long or net short, immediately he has to bring it back down to 15 million, net short or net long. Okay, in this case his net long has hit 25 million, so he has to bring the net long down to 15 million. Okay, so therefore he has to immediately sell 10 million. Now he can only get a two-way price, let's say from other market makers. He has to deal with other market makers. Okay, so now he has to go to another market maker and deal on his prices, and he has to sell 10 million. So at what price will he sell it? So Parul is saying 75. 73?
Yes, sir.
Clear? It's 73 because now when the market maker goes and deals with another market maker, he is now going to behave he is going to be treated like a customer or a price taker. Okay, so he has to ask another market maker for a price. In this case, the other market maker will quote him this price, 73, 75. So he'll have to deal on 73 because he's looking to sell. Okay, so he's looking to sell, so he'll have to sell at 73. Okay, but if he's able to sell, clear that transaction, then he's got his position down by 10. So he is now within his limits. 25 has gone down to plus 15 only. Clear? Is everyone following so far?
Yes, sir.
Okay, so now therefore what I'm trying to say here is the entire discussion is you understand a little bit about how the market making business works, and you also understand a little bit now about risk limits. On any trading desk or any market making, this is also going to be considered a trading desk. On any trading desk, there are going to be risk limits, okay? Because obviously you don't want to take too much risk. Because suppose, imagine, as I told you, I mean, if you have a situation like this, that the guy is long 75 million shares and assume these are shares of GE, the price of GE, and then suddenly the market collapses. So he will suffer a huge loss, okay? Which is what happened you've heard of the famous 1987 stock market crash in the US. You haven't heard of it? You should have heard of it. Okay, 1987 stock market crash. Okay, so although today on the charts, when you look at long-term charts, you can barely see it. But essentially, one of the things that happened was because everybody was dumping, there was a market panic. So everyone was dumping stock, all right? And the market makers were all getting very net long because everyone was dumping stock on them, and the market price kept collapsing. So eventually what happened is many of these guys, they stopped quoting prices. They basically said, which they are not supposed to have done, because that was their obligation to quote prices. Okay, so I think they didn't really face enough disciplinary action. They should have been severely disciplined because they failed to continue to quote prices. So this is one of the things that happens in a market panic. When the market is panicking, okay, and there's a sharp one-way movement and the market is panicking, you'll suddenly find, but this happens a lot, more in the OTC markets than in the exchange traded market, but this was the case of an exchange traded market, the New York Stock Exchange, where market makers refused to fulfill their duties and quote two-way prices. They basically stopped quoting because they had such massive long positions because everybody was selling to them and the market was collapsing. And they were sitting on massive losses, right? So they basically said, okay, I'm not going to quote prices anymore, okay? Because I can't afford to take any more losses, which they, strictly speaking, they did not have the right to do that, but that's what happened. So this is what happens in a market panic. So the point I'm trying to illustrate here is that because a market maker is not guaranteed to have a perfectly matched book at all times. You can't expect that every instant some guy is coming and selling you X amount on the bid, and some guy at the same instant some guy is coming and buying Y amount on the offer from you. This is an ideal situation. It's not going to happen in the real world, right? So you will have some kind of mismatch. Either you will be net long or net short. And in that case, since you don't know which way the market might go, basically these guys, in the market making business, you really don't want the market to move around too much. Because if you get a very big movement either way, you could lose a lot of money depending on how you're positioned, okay? So that's why I'm saying that these guys are the opposite of directional speculators. They don't want a big directional move. Ideally what market makers want, which you see very often happening in a lot of the foreign exchange markets, which are very liquid and they're not that volatile, not as volatile as the equity markets, okay? What they really want is something like, this kind of movement where you see here, if you just focus on this part, okay, where the market is dropping, then rising, dropping, and assuming that these moves are not very big. They're still quite big actually, but okay. So ideally what a market maker wants is in a narrow price range. Assuming you collapse this range even more. What they ideally want is the price to fluctuate in a narrow range, and they want high volumes, okay? So think about how a market maker makes money. If you look at the ideal situation for a market maker, what is the ideal situation? 50% trades on the bid, 50% trades on the offer, and ideally very high volume, okay? Approximately even distribution, 50% of the trades on the bid, 50% of the trades on the offer, very high volume and not much market movement. And let's take the extreme case of zero market movement. To understand the dynamics of the market making business, let's take an idealized situation where we have zero market movement. We have zero market movement, very high volume, okay, and perfectly distributed, perfectly evenly distributed sells and buys. So let's say you have very high volume, say it's a $10 billion worth of volume in a given day. A market maker has done a total of $10 billion worth of sales. 5 billion have been sold to him. 5 billion of the base asset was sold to him, and 5 billion of the base asset was bought from him. Okay, we are taking an idealized situation. It will never happen like this. But to understand the dynamics of the market making business, what is the ideal situation for a market maker? We are taking an ideal scenario. Okay, so you have a very high volume day, $10 billion worth of business. You have perfectly evenly distributed sells and buys. So $5 billion were sales to him, and $5 billion were buys from him. Okay, so 5 billion of volume was taken of the base asset, 5 billion was given to him, so perfectly matched. Okay, and zero movement in the price. Okay, zero movement in the price. So essentially what this guy has made is, if you assume this price is 73 and 75, so basically he has captured $2. We are ignoring the 40 cents. So he has captured $2, okay, on $5 billion worth of transactions essentially. Okay, buys and sells, he has got essentially $2 on $5 billion. This is clear to everyone? Okay, so this is a very good day for any market maker. So this is the ideal situation. What the market maker wants is not much movement in the price, tight range, price should be in a tight range, and there should be even distribution among the across the bid and offer. Okay, and then basically, yeah, so perfectly evenly distributed sells and buys, and very high volume, and not much movement in the price. This is the ideal situation for a market maker. Here he will make maximum money. If the price starts moving too sharply up and down, he could get caught on the wrong side. Okay, so generally market makers don't like that kind of a situation. Okay, so although sometimes you could make money on that as well, but essentially you are becoming like a directional speculator. Ideally a market maker should not be betting on big directional movement. He should really be trying to make money on the bid offer spread. Okay, so this thing is called the bid offer spread. We have it written down somewhere here. Very common logic. Okay, so this is called the bid offer spread. Okay, the gap between the bid and offer prices, okay, is the bid offer spread. So in this case we would say, in the case of Amazon, we would say the bid offer spread is, what is it? 2.4. Okay, so $2.40. This is the bid offer spread. Okay, so is everyone clear so far? Okay, now you understand why I said that market makers are not directional speculators. You see that the ideal environment for them is just the opposite of the directional speculator. Okay, so if I'm betting here that the euro is going to rise, okay, if I go long as a directional speculator, as an asset manager managing a currency fund, if I go long here, what I really want is a big move. It's now 112.40. I want a big move above, breaking above 114, you know, continuing this uptrend here, breaking above 114, heading up to 15, 16, etc. Okay, that's what I'm looking for, a big directional move in the underlying asset, in the base asset. Is this clear? That's why I'm a directional speculator, like an asset manager. But if I'm a market maker, I don't want these big moves. I want the price to be as tightly ranged as possible, in as tight a range as possible, not much movement in the price, massive volumes transacted, and kind of even distribution between my bids and offers. Okay, so is this clear? That's why I'm not a directional speculator as a market maker. I want the market to be very quiet. I don't want big directional movement. Okay, so you understand now a little bit about the dynamics of the market making business as well. Okay, that you should not really be taking, in the ideal sense, you should not be taking big directional risks. Okay, so now this is so we're just going to discuss a little bit about the bid offer spread. So now you understand why this classification as well. Now we'll just quickly recap before we go into the details of the bid offer spread. Just make sure we quickly recap the different categories of players in the market. We're losing the connection. Okay, so arbitrageurs, hedgers, and speculators. Speculators we have divided into directional speculators and market makers. Now everyone is clear about why we have this kind of nomenclature, okay, and very clearly defined, as you can see, because the definitions are such that you should not memorize them. You should be able to logically remember them based on what is their approach to risk. In that way you can define all the categories, right? And here, directional speculators, whether you want or you don't want directional movement in the price, based on that you have these two categories. Just use my see, this data is also not All right, we'll continue in the meantime with, all right, so now we go down to bids and offers. Okay, so the bid offer spread, we'll just wait for this thing to start responding. So the bid offer spread, now we're going to continue with the bid offer spread. We need to cover as much material as possible. Now, what can we learn from the bid offer spread? Now, you saw certain bid offer spreads you would have already noticed. We need this to come back. But you would have already noticed that when I was showing you the euro and the dollar yen prices, you would already notice that the bid offer spread in the euro and dollar yen is very tight. You notice that? Like in the euro also, you have to go to the 5th decimal to see a difference. Otherwise, it's all the same. Okay? So this is actually one of the ways we measure. You understand what is meant by liquidity? Which stocks are likely to be more liquid? The ones in the Nifty 50 or the ones not in the Nifty 50? Are they just saying that the ones which are not in the Nifty 50 are likely to be more liquid? That's what you said. You're wrong. Okay, so you're saying the ones in the Nifty 50 are likely to be more liquid. So what do you understand by liquidity? Yeah, so you're giving the classical corporate finance definition, which is good that you remembered. That liquid assets are those which can be readily converted into cash. Okay, so in a way that has the same meaning in the financial markets context as well. So liquidity is essentially a market that is very liquid, is one where you can easily sell or buy. Okay, you can you can trade in large volumes. Trade includes buy and sell. Okay, so you can trade in large volumes without significantly impacting the price, because the price will always get impacted by any transaction. Because if you're trying to buy, that means you're creating excess demand or excess supply. If you're trying to buy, you're creating excess demand. So normally ceteris paribus, you remember the expression from economics? Ceteris paribus?
Everything stays constant.
Yeah, other things remaining the same, right? So ceteris paribus, if there is excess demand, what will happen to the price? The price will go up, right? So now the question is, how much will the price go up? Okay, that economics doesn't tell you, because you can't really figure that out actually. There's no real way to know that. But the point is essentially that we define a liquid market as one in which you can transact in large volumes without significantly affecting the price. So even if you create very significant excess demand, the price will not move up that much because there's enough supply on the other side. Okay, so there's a market is deep enough to absorb that. 1 minute. Do you think this Chrome is freezing up because of the lack of the internet connection?
Yes.
Chrome does that, because maybe they are trying to constantly send your, you know that Google, somebody did some research on Google and found that even when your phone is not connected to the internet, they are collecting all your data. Like you go from here to the ATM, they log that, and later on when your connection comes back, they send that information that why your phone was off, you didn't have the internet, you went from here to the ATM, and they know that. They did some research and found that they track all your movement.
So probably you have not enabled offline editing in your Google Docs, that is why problem.
Okay, maybe that's why. Okay, what happened? This connection is limited. Why is this connection limited? Okay, let's try and continue whatever we can do without. It's connected now. Hopefully the data will come back. There should not be no internet access. I don't know why this is showing no internet access. Very strange. I have 2 GB of data per day, and I've not even used it. And this is like my backup actually. So, but I don't know why sometimes this gives this kind of message. I don't know whether it's the computer's Wi-Fi problem or. Okay, let me try and do this again. I don't know what the problem is. Whether it's a device problem or a computer Wi-Fi problem.
Karthikeyan sort of is wrong.
Yes?
Climatic conditions.
Okay. Oh, yeah. You mentioned this once, that because of the environment in the room. Okay. So don't say climatic conditions, you have to say environment in the room. Okay, now I understand. So it's nothing, neither my PC nor this, it's actually just the environment. What could they have done? I don't know why this problem is coming, because in the first few years when I joined DSB, we never had this problem. I don't know what the problem. Okay, guys, we have to just manage then. In this case, we just have to manage. So you have to pay more closer attention. We won't have internet access, and we'll have to just see what these guys are doing actually with this network. Oh, it's limited. What could they have done to jam the signal like this? Anyway, okay, so let's continue now. We have to just, we can't waste time waiting for this thing to come back. So we'll just have to, continue this way. So the bids and offers, so the bid offers, so one of the ways in which you, so first we understand the concept of liquidity. Liquidity, a highly liquid market means that you can transact in very large volumes, okay, without significantly affecting the price. That means you can go and buy massive amounts of the base asset and the price won't move up much, okay. We'll just have to give up on this. Okay, so the price won't move up much, even if you transact in massive volumes of the massive amounts of the base asset, the price won't move up much. All right. So that's the meaning of a liquid market. And one of the ways in which we assess the liquidity of a market is by looking at the bid-offer spread. So in a highly liquid market, what is likely to happen to the bid-offer spread? Is it likely to be narrower or wider? Narrower. Okay. So the size of the bid-offer spread is an indication of how liquid the market is. Okay. So obviously you have to adjust it when you're looking at different kinds of prices. Like different prices have different levels, right? Like for instance, certain markets have very low prices. Like maybe Intel stock is worth $14. Okay, so if you're looking at a spread on $14, okay, versus certain types of assets like gold might be worth $1,500. So when you're looking at a spread on a $1,500 price, okay, you can't compare it directly in absolute terms to a $14 price. You have to equalize it to the same dollar amount, okay, and look at the percentage difference in the bid offer. But the point is that in general, the size of the bid offer spread indicates the liquidity of the market. Okay. So we've got this back. Hopefully our software also has come back. Great. So now you can see here's an example of how liquid the market is. Okay. So you can see how liquid the foreign exchange markets are. Our data is live. Okay. You can see. Look at the dollar. Look at the two examples here. Euro and dollar yen. Why is the dollar yen price not showing? Maybe because of the lack of data. Okay. So you can see how tight the euro prices are. In the fifth decimal, that's where you can see the difference. Okay, this is how tight the euro prices are. Okay, the euro is the most liquid of the foreign exchange markets. Then you have the dollar yen, and you can see how dollar yen is also very tight. Can you see that? You can't see any. You have to go to the third decimal to see the difference. Okay, up to the second decimal is the same. So these are the two most liquid foreign exchange markets. And even cable, this GBP USD in the spot market is referred to as cable. I already told you the story. Here also you can see that it's very tight. Okay, but this is not as liquid as the euro dollar FX and the dollar yen. Okay, so you can see that the liquid markets have a very tight bid-offer spread. And let's just go down a little bit more to see. We have already all right. So essentially here, big words, but essentially what we are saying is the spread in any given market is not going to be the same all through the day. The spread will keep changing and it will reflect the level of liquidity in the market. Okay, so when you have essentially higher bid offer spread implies a less liquid market. Okay, so understand how the lower bid offer spread essentially results from competition among market makers. Remember, all market makers are trying to generate business. Okay, so if some market maker sees the price, maybe he looks at, we'll take different prices and we'll assume that they are actually the same. So if somebody, let's look at Apple. Okay, obviously the market is closed, so the spread is quite wide. But let's look at Apple and see, okay, some market maker sees that the Apple prices are actually 204, 26, we'll just say 2062. So the market maker sees 2062 and he says, okay, this spread is very wide. People don't have interest to transact in the market if the spread is so wide. Let me just quote a tighter spread. So he might quote, say, 30-40. So if he quotes 30-40 means he's willing to buy at 30 and sell at 40. So now he has narrowed the spread. Okay, so I'm giving you an extreme example, but this is how the spread comes down. So in a liquid market, essentially what happens is that you have more market makers typically in a liquid market. Okay, and typically liquid markets tend to be less regulated, which is why you see here the connection between every chance I get, I unleash on the Indian regulators for over-regulating Indian markets. Okay, you see the connection to that now, that essentially what happens, one of the things that happens when you over-regulate the market and you don't allow players to come in, like the classic example is the Indian bond market. If you look at the Indian corporate debt market and the government debt market also, we have all kinds of limits on what FIIs can invest in, right? You can invest in so much, and the way we manage it, that when we feel more confident, okay, from 15% we raise it to 18%, then we raise it to 25%. So this is kind of micromanaging, okay? But essentially what happens is, and we put all kinds of restrictions on how they can hedge and not hedge their foreign exchange exposures and all that, okay? So by putting all these restrictions, what you're essentially doing is you're not allowing large volumes of foreign capital to come into the market, and that is affecting the liquidity of the market. So the liquidity, the debt markets in India are not as liquid as they could be if we had allowed more people to come in. And the fear is, the general policy fear is, that if we allow lots of people to come in, then when there's some kind of market panic like this NBFC crisis that you had, then a lot of capital will flow out. Okay, so, but then this is a problem which, it's like, this you cannot ever get. This is actually, it's like failing to understand. Partly what they're doing is they are not able to appreciate the benefits of higher levels of participation, and they have too much fear about what will happen when capital flows out. Because capital flows out means, in the sense that it's not that every foreign investor has the same time horizon. Some people will have in any market, some people will have a short-term horizon, some people will have a medium-term horizon, some people will have a long-term horizon. If you open up the market to all the investors, there will be some longer-term investors. So some people who are fleeing in a time of panic, some people might see it, some other investors might see that as an opportunity to come in. So there are self-correcting mechanisms. So essentially, these kinds of decisions happen because people don't understand the power of free markets to provide liquidity, to bring prosperity and all that. So essentially, it comes from a failure to appreciate the benefits of a free market. So if you look at the US markets, the US has a very big debt problem. Their debt is equal to almost 22% of GDP, is 22 trillion, which is about 100% of GDP almost, slightly more than 100% of GDP, the US debt. The national debt is around 22 trillion now, and their GDP is around 20 trillion. So their debt is about more than 100% of GDP. But you see, actually, if you look at US markets, what is happening if you look at, we're going into a policy discussion. I hope you guys don't switch off when I have policy discussions. Are you finding it not interesting? What? Because everybody kind of goes dead. What?
Not interesting.
What? Not interesting. Not interesting. Why are policy discussions not interesting? Isn't policy everything at the end of the day? Policy is everything, right? Policy affects you, policy affects everybody. Okay. What happened? Okay, so the point I'm trying to make here is that the US debt is actually, people have been, afraid of what the US debt will do to the US economy from the time I entered the market around 1989. From there on, I've been hearing stories about how the US debt is going to destroy the US economy. And that time the debt was much lower. It was around, I think it's around 5 trillion or something. And now the debt is 22 trillion, okay? But now still look at how low the interest rates are. Okay, so this is kind of the time when I entered the market, and so it's going down continuously while the debt has been increasing continuously. And you see how now, even now the debt is the interest rates are quite low. This is 2.06% is what the US Treasury is paying for borrowing for 10 years. Okay, the US Treasury is paying 2.06% for 10-year borrowing on the international capital markets, okay, the US capital markets essentially, because they have a freely convertible currency. So one of my points is that, when one of the things we don't realize in India is why is this the case? Why is the US government not paying a higher interest rate even though their debt is more than 100% of GDP? One of the reasons for that is that the US market, obviously it's a very big economy, is the biggest and the most deepest capital markets in the world. So any central bank anywhere which has a surplus, what do they do with that surplus? Some of that they buy gold, like even our reserves. If you look at RBI reserves, what do they do? And then the next option is invest in US Treasuries. Because when you invest in US Treasuries, it's a free market. They don't put, unlike us, they don't put all kinds of caps. Who can invest how much, who can take out how much money, at what point of time, whether you can hedge, not hedge. It's a free market. You come in, whatever you want to do, come in, buy, sell, go back. Okay, so it's a free market, so people feel comfortable that nobody's going to stop me if I need to pull the money out. So that's why all the world's capital goes into the US capital markets, and that is one of the reasons why the US government is able to borrow at such low interest rates. Okay, even though their debt is more than 100% of GDP. Okay, this is one of the reasons, because Japan is another example. Japan's debt is even worse. I think those guys are about 160% of GDP or something like that. Their national debt is more than 100%, 160% of GDP. But even Japan has a freely convertible currency. Today, anybody from India can go, let's say IDBI Bank has excess reserves, they want to invest something in the IDBI Bank is not a good example because RBI will prevent them from investing abroad freely. But if the RBI wants to invest some of India's reserves in Japanese government bonds, they can freely go in and buy as much as they want, okay? And they can then, whenever they want to sell, they can freely sell and come out. Nobody's going to say anything to them, okay? That's why. So the point is that if you close the door, okay, or you put all kinds of restrictions on people exiting, then obviously not many people are going to come in the first place. You follow the logic? As an investor, if I think that I can't even go out when I want to, or I have all kinds of restrictions, then they will not come in the first place. So therefore, the point is they should realize the benefits. So these are some of the benefits. When you have deep and liquid capital markets, and that only happens from, we are looking at the same logic here. You saw how this happened, right? That you have a lower bid offer spread is from competition among market makers. Okay, so one guy sees the bid offer spread as being very wide, 30-90 on Apple. He says this is too wide, let me quote 40-60 so I can pick up the business. Okay, if I quote 40-60, more people will come and deal with me. Okay, so that's, you understand the logic here? Okay, he's quoting a tighter price, better price. Okay, both sides are better. 40 is better than 30 as a bid, and 60 is better than 90 as an offer. Okay, so this is how you get competition, and this is how you get a more liquid market. And where will the competition among market makers come from? If you have many market makers, then there will be competition. If you are restricting the number of investors, so the moment you restrict the number of investors, you are automatically affecting the liquidity of the market. So these are some of the things that our policymakers don't think about, which is that by restricting the number of players, because you have a fear that, oh, when these guys go out, there will be volatility and all that. What you are doing is you are affecting the liquidity of the market. And by affecting the liquidity, you are affecting the transaction costs of people who are going to use the market. Come back and look at the foreign exchange market. You see how tight the euro is? Okay, how tight the spreads are? Who needs to buy euros? All kinds of companies around the world. Toyota Motor has to sell. Let's say Toyota Motor is selling a large volume of cars into Europe. Eventually those proceeds have to be repatriated. They need to sell those euros and buy yen. Okay, so you can think of this as a two-leg transaction. First they'll sell the euros and buy dollars. Then they'll sell the dollars and buy yen, because ultimately Toyota wants yen. So here's an example of a corporate customer who needs to use the foreign exchange markets. Okay, so let's quickly test your concepts. When Toyota Motor wants to go from euros to yen, we're going to make it more complicated because actually, although you have a direct market in euro yen, I'm going to make it more complicated to test your concept. So you're the treasurer of Toyota Motors and you have, let's say, 5 billion euros in your quarterly sales revenue that you need to send back to Tokyo, okay, and you're sitting here in Frankfurt and you need to trade in, you need to sell 5 billion euros and buy yen, okay, you can't trade directly in euro yen, we are just putting that restriction. So what are you going to do now? Which price are you going to hit on the euro? Now we can't even say which one, the left or the right? Left, okay, because I'm a seller of euros. So you need to understand in this market, the euro dollar FX market, what is the base asset? Okay, so sorry, I forgot it. That let's finish this problem then. So euro dollar FX, what is the base asset? Euro. Some people are not sure. Shivam is not 100% sure. What is the rule I told you? This is a matter of convention, so you can sort of memorize the rule that the base asset is shown first. In the foreign exchange markets where they show two assets, the base asset is shown first, okay? So now you're clear, Shivam? The base asset is shown first, so Euro USD means Euro must be the base asset. Eventually you will get to know by just getting familiar. So the Euro is the base asset. So this price bid and offer means that you are selling when Toyota Motor is selling, and these are the market makers' prices, they will have to sell on the market makers' offer or bid? Bid. They'll have to sell on the market maker's bid, so they have to sell on the price on the left. Because we can't even say 39 because both are 39. So we have to say 4 and 5 here, okay? So 1 and 2, okay? You guys can still see 1 and 2? SG1, you can see that? Okay. Alright. So first he sells at 39.1, he sells the 5 billion euros. Okay, he gets some amount of dollars. Okay, how many dollars does he get? How do we get, what is the formula? 5 billion into 1.12391. He gets that many dollars. Okay, now he needs to, it's not good enough for him to have dollars, he needs yen. So now what does he have to do? Buy dollars or sell dollars? He has to sell dollars and buy yen. So now he goes to the yen market makers. Now sell dollar and buy yen. At which price will he sell? 4 or 5? Ask price. I'm selling dollars at 5 on the ask price. Okay, who's saying ask price? And who are saying, some people, there's a difference of opinion here. Okay, let's first be clear about the concepts. Dollar yen, which is the base asset? In the dollar yen market, what is the base asset? Dollar is the base asset. Okay. And what am I trying to sell? Dollars. I'm trying to sell the base asset. So the bid, I will sell either on the bid or on the offer. Now, am I a price maker or a price taker? As Toyota, I am a price taker. Some people are not clear about this also. Some people are saying maker. Taker, right? As in T for Trivandrum. T, right? Anybody, everybody in T or M for Madras? Anybody? T for Trivandrum. Okay, okay. So I am a price taker. Is everyone clear? Anjum, you're clear? Sukriti? Okay. Okay, so I'm a price taker. Now what am I trying to do as a price taker? I'm trying to sell the base asset. So I have to deal at the price at which the market maker is willing to buy or sell the base asset. If I'm selling the base asset in the transaction, what is the market maker doing? He is buying the base asset. If I'm selling the base asset, that means he has to be buying the base asset. So at what price is he buying the base asset? At the bid. Is everyone clear? Yes. Have you followed the logic? Yes. Please make sure you go and revise all this stuff, okay? Because if you don't revise it, you won't be able to internalize it. You're still making some mistakes, which is natural because you're encountering these concepts for the first time. So it's not that they're very complicated, okay? But it's just that it's technical and you have to be careful. You just have to be careful, that's what matters. So once you revise it a few times on your own, then you can actually make sure you replay the video, go through the same questions and make sure you can understand and answer the questions. And then everything should become, so once the concept is clear, then everything will be clear to you. Okay, so therefore now Toyota will sell at the bid price. Yes or no? Yes. Bid price. So at 74.5 they'll sell the dollars that they got from the euro dollar FX transaction. Okay, is this clear? Yes, sir. Okay, so they'll sell it here. Now they'll have some amount of yen. How much yen? whatever dollar amount they had into 107.747. That's the amount of yen. Okay, and then that yen will be sent to their account in Tokyo. Is this clear?
Yes, sir.
Is everyone clear now about this? Okay, so now here's an example. Now what happens is, now we are making a connection between the corporate use of the market. So the Toyota Motor in this case is called an end user. We would classify Toyota Motor as an end user of the FX market, because they are actually not in the business of, they are not a foreign exchange market maker, right? Toyota Motor is not a foreign exchange market maker, but in the course of doing their business, running their own operations of selling cars, they eventually have foreign exchange exposures. This is a foreign exchange exposure for them, because they have $5 billion worth of sales, 5 billion euros worth of sales in Europe, and that's no good for them because their earnings are in yen, their statements are in yen, so they need to send those euros back to Japan in the form of yen. So they have a yen, they are actually long, essentially here we would say, because they need to buy yen and they have euros which they want to sell. So we say here that they are long yen, they are long euros and short yen. Okay, they are long euros and short yen. So essentially they have a foreign exchange position. So as a result of their normal operations of making and selling cars, they have ended up with foreign exchange exposure. They did not ask for it. Okay, but because Toyota would have been just as successful if the whole world had only one currency, right? If the whole world had one currency, we presume they would have been just as successful, right? Because they're not connected to the idea of multiple currencies. But because the world does not have one currency, now they've ended up with currency exposures as a result of doing their business. Okay, so this is what we call an example of a passive risk book, which we'll study later. But you can get this idea that corporates end up with foreign exchange exposures even though they don't really want them. They don't necessarily want them, but they have these exposures. So one of the things you can see that because the spreads are so tight, now sometimes what might happen is a big company like Toyota might have other side exposures. Sometimes they might need to buy euros and everything may not be perfectly matched. The time when they had to sell excess euros to sell, at that time they may not know that they have a requirement to buy euros also. But suddenly something might happen after 2 months, they might have to buy euros. Okay, some operational requirement, they might have to buy euros. Okay, so in this case, when you have a big company with complex operations, you might have suddenly another foreign exchange need, right? So again, then in this case, now they'll have to go and deal on the opposite side, right? They will have to now buy, therefore they'll be buying euros on the market maker's offer, etc., right? So the point I'm trying to make here is that when you have tighter bid-offer spreads, you have a more liquid market with tighter bid-offer spreads, that is more beneficial to end users of the market because their transaction costs. So there's an economic concept of transaction costs. Okay, transaction cost is not difficult to understand. You can even think of it in more everyday terms. If you have to go to a new house, let's say you get posted to Bombay, you have to search for a new house. How much are you going to search? You may not find the right perfect place. But after searching for 6 or 7, after seeing 15, 20 houses, at some point you're going to say, I just can't take it anymore, I'll just take something which is acceptable. Right? That's what you do. So essentially what you're doing is you're saying that you can't handle the transaction costs anymore. Because technically you can keep on looking for a house until you find the perfect house. You keep on looking for 60 houses, 70 houses. At some point you decide that the transaction cost of looking for the perfect house is too high. I just want to close it and finish it out right now. Okay, so that's an example of transaction cost as well in an economic sense. But here you have a clearer example of transaction cost where Toyota has to buy and sell euros both. They are on both sides of the transaction very often. So if the market bid-offer spreads are tighter, they get more bang for their buck. Do you see that? That from Toyota's point of view as an end user of the market, having tighter bid-offer spreads is beneficial for them directly. They make more money. Do you see that? Because in this case, instead of selling dollars at 73, if they had to sell at 70, then they would get less yen. If they're going to sell at 70, they would get less yen. So the tighter the bid-offer spread, the better it is for the end users because their transaction costs are lower. So if Toyota had to sell instead of 73, they had to sell at 70, we would say that their transaction costs are higher. This is clear? The concept, we have now brought in another concept of transaction cost. Okay? So transaction cost, a simple way to measure transaction cost is to just dollarize the bid-offer spread if you want to compare. Okay, in this case we'll just keep it one level simpler, and we'll just say we look at the absolute level of the bid offer spread, and you can see that the wider the bid offer spread, the higher the transaction cost. Is this concept clear to everybody?
Yes, sir.
Right? So this essentially, so this is another reason, and once again we can correct it with apologies to Tarun, we can once again connect it to the policy question, that when you have liquidity, when you have, see, this is what happens, when you restrict the number of players, are you able to see the connection between market liquidity and the number of players in the market? The more players you have, if you open the door to everybody in the world, more and more people will come in, and kind of on an average over the long term, some people will be sellers, some will be buyers, some will be long term, some will be short term. Not everybody has the same horizon, okay? So there will be an even distribution more or less over the long term, okay? But the more the players, the more liquid the market, okay? The more the players, the more liquid the market, and the more liquid the market, the tighter the transaction cost, the tighter the bid offer spread. Are you following? The more liquid the market, more players translates to more liquidity. More liquidity translates to tighter bid offer spreads. Are you following the logic?
Yes.
Okay. And then tighter bid offer spreads translates directly to benefits to end users, like corporate customers. Okay. So in India, if I was giving you the example of the bond market. One of the problems we have in the bond market, the reason you have all this big NBFC crisis and all these problems with the public sector banks, one of the reasons is the Indian corporate sector is over reliant on bank finance. Okay, if you look at developed economies like the US, we'll study this later when we study capital markets, but in the developed economies, financing comes much more from capital markets and less from the traditional banking sector. And here's an example, India is an example now, unfortunately, as an example, our financial sector development hasn't kept pace with the real economy, that we are actually underdeveloped. So there's more reliance on bank finance, and that's why, because the banks are financing everybody, they're not diversifying their risk, they're not able to diversify the risk. So all these NBFC problems, everything comes down to the banks eventually. All the problems can eventually come into the public sector banks. Okay, so therefore, if we had a more developed, and what has hindered the development of the capital markets? Over-regulation, trying to restrict the players who can come in. So if we had more players, more open markets, more players, more liquidity, tighter bid offer spreads, corporates could have borrowed at a lower cost in the capital markets. Our debt markets are a disaster basically. They are literally non-existent. Okay, so you'll see another bias here basically, because of debt markets are typically OTC markets, and we have a very anti-OTC market bias in our regulation. And that's why debt markets are not. So the net result of underdeveloped debt markets is corporate sector is not able to borrow at lower costs. Are you following?
Yes.
And you see how it has a direct connection to the competitiveness of the economy. If your debt funding is at a higher cost, your total cost of capital will be higher or lower?
Higher.
Higher. And if your cost of capital is higher, is it going to be a competitive advantage or a disadvantage? Disadvantage. That's one of the reasons why you see everywhere in the world American companies are dominating. Why? Because their cost of capital is lower. Because they have more developed capital markets. Capital market funding typically is cheaper than bank funding. Okay, this is one of the reasons. There are many other reasons why they're dominant. Okay, because they have free markets, less regulation overall. So, but this is one of the factors. So these things, our policymakers have never thought about these things. Their only thing is, oh my God, so many players, volatility, they'll run away with their capital and there'll be ups and downs in prices. But the point is, by focusing on this one fear, they have lost out on, they don't have a vision of what they have lost out on. Okay, by not having these benefits from free markets. Anyway, so we still have 2.5 minutes. We can make good use of our time. Okay, so is this clear now how competition among market makers reduces bid offer spreads?
Yes, sir.
Okay, good. That's a very tired yes, sir. That means you are dying for the market to end. Okay, one more comment. So for the class to end. Okay, read this part in yellow. I don't know if you can read it. I'm just going to reduce it and make it. Now you can read it. Okay. So the point I'm trying to illustrate is all this funny stuff that you can't read it now. Shreya, what happened? Is this? Can you read it? Okay. Let me just make.
Now we can read.
Now you can read. Okay, so the point is, I'm just trying to illustrate. You might wonder about this funny stuff here. Well, let's just close it today with a discussion of pipettes. Okay, these I'll put these two links also in your notes in the notes that you have access to. So essentially, pipettes is what we are saying is just the idea of price improvement by adding decimals to quotes. Okay, these are called pipettes in FX code. Fifth decimal in dollar Swiss or third decimal in dollar yen. So what I'm trying to illustrate here is just this. Okay, please pay attention, guys. Please pay attention. Last few minutes. Just an example of how competition among market makers has led to adding to the decimals and tightening the spread. Do you agree that let's say we can't even take this because these are so tight. Okay, so let's say I have 3580. Okay, so if I have 3580 on Apple, okay, let's just focus on Apple. I have 3580 on Apple. Now if I, as a new market maker, I want to make my price more attractive. So if I quote 35 half, 75 half, is it a tighter spread? Instead of 3580, I quote 35. No, I'm trying to show you the decimal place, adding the decimal place. Now I'm going to quote 35 half, so 20.35 cents and half a cent. 35 half. I'm only quoting the cents here, okay? So this is 35 80 cents. 35 cents 80 cents right now. Is this clear? So I want to give a more competitive quote. I'm a new market maker. I want to make my name in the market. I want more business. So instead of quote, I see that the market is 35.80. What do? I quote 35 half, 75 half. So I quote 35.355, 0.755. Is this a tighter spread?
Yes, sir.
It's a tighter spread, right? So you can see how by adding a decimal point I can improve my the competitiveness of my quote. Is that clear?
Yes.
Okay, so what you see here, the reason you see these FX quotes, these are superscripts. Can you see that? 74.4, 74.5. Now in FX earlier, dollar yen was only quoted to two decimals. Euro was only quoted to 4 decimals. Okay, but because the market is so active and so many players, it's so competitive. Now the market has moved to 5th decimal quoting because people are trying to distinguish themselves by quoting tighter and tighter prices, trying to gain volume. Are you following the logic? The same logic that you are adding a decimal place, making your prices even more competitive. But ideally this can happen in a market. Now if in our market the regulator will come in and say, no, you can't quote to 5 decimals.
Yes.
Okay, well that's what they do. First thing they say is no. Okay, so you can't quote to 5. Then what you're doing immediately, you're stopping the market from innovating and creating benefits for customers. Is this better for customers or not?
Yes.
Third decimal quoting in dollar yen better for customers? Right? Yeah, Karthik is very concerned that the time has been crossed. But I'm just trying to illustrate a point. Is this clear?
Yes,
So another point I've shown you now is how adding decimal points to price quotations is basically happening because market makers are competing with each other and trying to gain business. This is what competition does. Competition lowers costs. Okay, and that benefits the end users.
Yes.
This idea should be clear in your head, right? Okay, I'm going to deduct 2 marks for Karthik and Yash for too much activity. No, you guys were talking between yourselves.
No, sir, we have.
No, I saw. No, I saw you guys. You were talking between yourselves, and you got up also. You got up before the class was over. Okay, class is dismissed.
I was not talking.
1 minute. No, you don't have to talk. You don't have to talk. You just have to be engaged in activity which is not. No.
Speak a single word.
No. You have to be focused on what is being discussed in the class. Any kind of defocusing, doing your own thing.
You haven't speak a single word, sir. Why are you?
You don't have to speak. You don't have to speak. You have to be just engaged in activity which is other than what you are supposed to be doing, which is focusing on the class. Okay, class is dismissed. Anybody, any questions, technical questions, you can come here, then I won't close the video.
Sir, I swear I didn't.
1 minute. I'm not going to